Most people enter investing believing the danger lies in choosing the wrong stock. In reality, the real danger shows up much earlier, in the habits, assumptions, and mental shortcuts investors carry with them long before they ever place a trade. Over decades of watching markets rise, crash, recover, and surprise everyone, one pattern becomes unmistakably clear. Wealth is not destroyed by lack of intelligence, but by repeated, avoidable mistakes that feel reasonable in the moment. The market doesn't punish ignorance as harshly as it punishes overconfidence. Many investors lose not because they didn't know enough, but because they believed they knew more than they actually did. One of the most damaging errors is the obsession with predicting what the market will do next. People spend endless hours trying to forecast interest rates, elections, inflation numbers, or short-term price movements, convinced that certainty is just one insight away. But markets are complex systems influenced by millions of decisions, emotions, and external shocks that no model can fully anticipate. Even professionals with vast resources fail at this consistently. Long-term evidence shows that missing just a handful of the market's best days can drastically reduce overall returns. Yet those days often occur during periods of fear, when most people are on the sidelines. The paradox is cruel. Those who try hardest to avoid losses often guarantee them by staying out too long. Another subtle mistake is treating stocks as pieces of paper rather than ownership stakes in real businesses. When prices fluctuate daily on a screen, it's easy to forget that behind every ticker symbol is a company selling products, serving customers, managing costs, and competing in an industry. Short-term price movement reflects emotion far more than reality. Fear exaggerates risk. Optimism inflates promise, and both distort judgment. Investors who constantly react to price changes end up trading their peace of mind for activity, mistaking motion for progress. Real investing happens quietly, over time, while impatience demands constant action. Closely tied to this is the dangerous habit of anchoring decisions to the price you paid. Once money is committed, emotion sneaks in. Investors defend bad decisions because admitting a mistake feels like failure. Instead of asking, "Is this business worth owning today?" they ask, "Can I get back to my original price?" This mental trap leads people to hold declining businesses far too long while selling strong ones too early. Markets do not remember what you paid. They only respond to future expectations. Refusing to accept this reality turns investing into an emotional negotiation rather than a rational process. There is also a widespread misunderstanding about risk. Many assume risk means volatility, that if a stock price moves sharply, it must be dangerous. But volatility is not risk. It is uncertainty of price, not uncertainty of outcome. The true risk lies in buying businesses you don't understand, companies with weak economics, excessive debt, or fragile competitive positions. A stable-looking investment can permanently destroy capital, while a volatile but high-quality business can reward patience handsomely. Confusing price swings with actual danger causes investors to avoid opportunities that look uncomfortable but are fundamentally sound. Perhaps the most overlooked mistake is ignoring time itself. Compounding is often praised, yet rarely respected. People underestimate how powerful consistent, disciplined investing becomes when allowed to operate uninterrupted. They interrupt it with unnecessary trades, emotional exits, and constant strategy changes. The market rewards endurance far more than brilliance. A good decision held for decades can outweigh dozens of clever short-term moves. But this requires resisting the urge to always be doing something, a skill far rarer than intelligence. By the time most investors realize these mistakes, they have already paid for them, sometimes with years of lost progress. The tragedy isn't that these lessons are difficult, it's that they are simple, unglamorous, and ignored. Investing success does not demand extraordinary insight.
It demands the humility to accept uncertainty, the discipline to stay patient, and the wisdom to avoid errors that feel exciting but quietly erode wealth.
Once investors move past the obvious errors of prediction and emotional attachment, a more dangerous layer of mistakes begins to surface. Mistakes rooted not in what people do, but in what they believe about investing. One of the most damaging beliefs is that diversification alone is a substitute for understanding. Many investors spread money across dozens of stocks, funds, or strategies without knowing why any of them should succeed. This creates the comforting illusion of safety while quietly guaranteeing mediocrity. True diversification protects against ignorance, not volatility. Owning many businesses you don't understand doesn't reduce risk, it multiplies confusion. When markets turn hostile, these investors have no conviction, only panic, because they never built a foundation of understanding to lean on. Another silent mistake is paying too much attention to stories and too little to economics. Humans are wired for narratives. A compelling vision, a charismatic founder, or a popular trend can override rational analysis almost instantly. But businesses are not novels. They are systems of costs, margins, competition, and capital allocation. A company can have a brilliant story and still be a terrible investment if the underlying economics are weak. Investors who confuse innovation with profitability often discover, too late, that growth without durable advantage simply burns cash. The market eventually corrects these illusions, but it does so without mercy. Equally destructive is the tendency to overestimate how much change is required to justify action. Many investors abandon sound strategies because they feel boring. When returns arrive slowly and steadily, impatience whispers that something better must exist elsewhere. This leads to constant strategy hopping, chasing hot sectors, rotating portfolios, reacting to headlines, all of which erode returns through friction, taxes, and poor timing. Stability feels uncomfortable in a world addicted to stimulation, yet long-term success often looks uneventful while it's happening. The greatest compounding occurs in silence, not excitement. Another mistake that reveals itself over time is misunderstanding the role of cash. Investors often view cash as wasted potential, something that must always be deployed. But cash is not laziness, it is optionality. It provides flexibility when opportunities appear and protection when conditions deteriorate. Forcing money into mediocre opportunities just to stay fully invested reduces future choices. Patience is not inactivity, it is preparation. The ability to wait, especially when others feel compelled to act, is one of the most underappreciated advantages in investing. Then there is the error of ignoring incentives, both personal and institutional. Many financial recommendations are shaped not by what benefits the investor, but by what benefits the advisor, the fund manager, or the platform. Short-term performance is rewarded, long-term discipline is not. This misalignment pushes investors toward complexity, frequent trading, and constant engagement, none of which improve outcomes. Understanding who profits from your activity and who doesn't is essential. Simplicity is often discouraged precisely because it works without generating fees, attention, or excitement. Over time, these mistakes compound just like returns do, only in the opposite direction. Each small error seems harmless alone, but together they form a pattern of leakage, lost opportunities, unnecessary risks, and emotional exhaustion. The market does not require perfection, but it punishes inconsistency. Investors who succeed are those who avoid all errors, but those who eliminate the most costly ones early and refuse to repeat them.
As time passes, investing stops being a test of knowledge and slowly becomes a test of temperament. This is where many capable investors quietly fall behind. They understand the principles, recognize the mistakes, and even agree with them intellectually, yet still fail to act accordingly when pressure arrives. The gap between knowing and doing is where results are decided. Markets have a unique way of exposing emotional weakness, not through sudden disasters alone, but through long periods of boredom, doubt, and delayed gratification. These conditions erode discipline far more effectively than panic ever could. One of the most underestimated challenges is dealing with uncertainty. Investors crave confirmation, numbers that reassure, headlines that validate decisions, experts who agree. But certainty rarely appears when it's most needed. The best opportunities often arrive when information is incomplete and sentiment is negative. Acting during these moments requires an acceptance that clarity comes after commitment, not before it. Those who wait for comfort typically pay higher prices or miss opportunities entirely. The market rewards those willing to be early and patient, not those who demand reassurance. Another psychological trap is comparison. Investors constantly measure themselves against others, friends, social media personalities, short-term market winners, forgetting that investing is not a competitive sport with synchronized timelines. Someone will always appear smarter in the short run. Chasing relative performance leads to distorted decision-making, pushing people toward risks that don't match their goals or temperament. Long-term success is deeply personal. It depends less on what others are doing and more on whether you can stick to your own framework without flinching. There is also the subtle danger of ego. Success, even modest success, can create the illusion of skill where luck played a significant role. This encourages larger bets, reduced caution, and a belief that past outcomes confirm superior judgment. Markets are unforgiving teachers in this regard. They allow overconfidence to grow slowly and then dismantle it quickly. Investors who survive long enough learn to treat confidence as something to be managed, not indulged. Humility is not a personality trait in investing, it is a survival mechanism. Another overlooked mistake is the failure to define what enough looks like. Without a clear endpoint, investors drift into perpetual optimization, always chasing slightly better outcomes at the cost of increasing risk. Wealth becomes a scoreboard rather than a tool. This mindset leads to decisions that maximize returns but minimize peace of mind. The irony is that many financial failures occur after success, when discipline loosens and purpose fades. Knowing why you invest is just as important as knowing how. Perhaps the most difficult lesson is accepting inactivity as a decision. Doing nothing feels irresponsible in a world that celebrates action. Yet most great investment outcomes are the result of long periods of waiting, punctuated by a few well-timed decisions. The inability to sit still, to allow compounding to work uninterrupted, destroys more returns than bad analysis ever could. Patience is not passive, it is active restraint. By this stage, the mistakes are no longer technical, they are internal. They emerge from fear of missing out, fear of being wrong, fear of standing alone. The market doesn't exploit these fears intentionally, but it doesn't protect anyone from them either. Those who endure are not necessarily smarter, they're steadier.
As investors gain experience, the mistakes that matter most are no longer obvious errors or emotional reactions, but flaws in structure. The systems they build, the rules they fail to define, and the filters they never put in place. Without structure, every decision feels new, urgent, and emotionally charged. This is where many long-term results quietly unravel. Successful investing is not about constantly deciding what to do. It is about deciding in advance what you will not do. Without clear boundaries, investors slowly drift into complexity, reacting to circumstances instead of operating from principle.
One of the most damaging structural mistakes is confusing activity with progress. Frequent portfolio changes feel productive, but most of the time they simply introduce friction, taxes, fees, timing errors, and emotional fatigue. Each decision carries a cost, even when it appears small. Over decades, these costs compound against the investor. The most successful approaches often involve fewer decisions, not more. Reducing decision frequency reduces error probability. This is not restraint born from fear, but efficiency born from experience. Another overlooked error is failing to match strategy to temperament. Investors often adopt approaches that sound impressive but are incompatible with how they actually behave under stress. A strategy that looks brilliant on paper can collapse in practice if it requires emotional control the investor doesn't possess. The market doesn't reward theoretical discipline, it rewards applied discipline. Choosing a strategy you can sustain through boredom, drawdowns, and doubt is far more important than choosing one that looks optimal in hindsight. There is also the mistake of ignoring scale. What works with small amounts of capital does not always work as money grows. Liquidity matters, opportunity sets change, risk tolerance shifts. Investors who fail to adapt their framework as their situation evolves often cling to outdated habits that once served them well. Flexibility here is not inconsistency, it is realism. Long-term success requires recognizing when the rules must evolve without abandoning the principles behind them. Another silent failure comes from neglecting downside planning. Many investors obsess over upside scenarios while barely considering what happens if they are wrong. They assume diversification or optimism will protect them. But resilience is built deliberately. This includes margin of safety, conservative assumptions, and the willingness to walk away from opportunities that don't offer asymmetric outcomes. Avoiding catastrophic loss matters far more than capturing every gain. Survival is the first requirement of compounding. Perhaps the most costly structural error is allowing external noise to override internal judgment. News cycles, forecasts, opinions, and constant updates erode clarity over time. Investors who consume too much information often make worse decisions, not better ones. The signal-to-noise ratio in markets is brutally low. Filtering information is as important as acquiring it. Without filters, attention becomes scattered, conviction weakens, and strategy dissolves into reaction. By this point, the dividing line becomes clear. The difference between lasting success and slow erosion is not intelligence, access, or even experience, it is structure. Those who build systems that protect them from their own weaknesses quietly outperform those who rely on insight alone. The market rewards preparation far more consistently than brilliance.
After decades of observation, mistakes in investing stop looking random. They form patterns. And beneath every pattern is a single underlying truth. Investing success is less about intelligence and more about alignment. Alignment between knowledge and behavior, goals and actions, patience and time. Most people fail not because the market defeats them, but because they quietly abandon their own principles under pressure. The market doesn't require brilliance, it demands consistency. And consistency is far harder to maintain than most people expect. At the core of every enduring investment outcome is a respect for reality. Reality that markets will fluctuate. Reality that uncertainty never disappears. Reality that no strategy works all the time. Investors who accept these truths early stop searching for perfection and start building resilience. They understand that losses are not signs of failure, but costs of participation. What matters is not avoiding discomfort, but avoiding irreversible damage. The final and perhaps most subtle mistake is confusing understanding with application. Many people know what they should do. Far fewer actually do it.
The difference lies in behavior under stress. When prices fall, headlines turn negative and doubt creeps in. Theory offers no protection, only preparation does. Investors who succeed design their decisions so that discipline is easier than impulse. They remove unnecessary choices, limit exposure to noise, and rely on pre-committed rules rather than emotions. Long-term wealth is built by making a small number of good decisions and refusing to undo them. It is protected by saying no far more often than yes. The hardest part is not finding opportunities, but waiting for the right ones without losing conviction or patience. Time rewards those who respect it. Compounding favors those who do not interrupt it. In the end, the greatest investing advantage is not access to information, speed, or sophistication. It is temperament, the ability to remain rational when others are reactive, calm when others are anxious, and patient when others are restless. Markets change, human behavior does not. Those who understand this stop fighting the market and start working with it. And that is the quiet difference between those who spend a lifetime chasing returns and those who allow returns to come to them.